Okay, we're going to continue on here with Chapter 1, Problem 1. This is the rest of Part B and Part C. So this is still Chapter 1, Problem 1, the rest of Part B, and all of Part C. Okay, so let's take a look here. They tell us that they want us to do a statement of change in stockholders' equity. That's just accounting speak for how much more or less is the company worth to its stockholders. This is pretty common sense when you think about it. It's what you had at the beginning, plus whatever you made, minus whatever you gave away. That's what you have left. So at the beginning, and this was from the last problem, this was from the first part, we're told that our common stock was $6,000. That's what we started with. So we started with $6,000 in common stock. The very first transaction was we sold $30,000 worth of common stock. We got cash, we gave stock, so $30,000. So our ending common stock, we'll put it out here to make it easy to see, it's $36,000. The hardest part about accounting is getting down the lingo, learning the language. The math is simple. It's add, subtract, multiply, and divide. Every one of you can do that. The hard part is the language, and that's what you're learning. So, our beginning retained earnings, again, go back to the sheet they gave us. They told us our beginning retained earnings was $8,000. So, beginning retained earnings, $8,000. Now, if you remember right, we came up with some net income of $4,000. And remember that net income comes right through that funnel, right to retained earnings. So let's do it. $4,000 minus the dividends. Because again, remember we said that we gave some money back to our shareholders. We gave $2,000 in dividends. Dividends are not an expense. Underline not in your head. Dividends are not an expense. You're giving away some of your earnings. If you give away your earnings, it's dividends. If you retain your earnings, it's called retained earnings. See how bloody clever we are? So we're going to subtract that $2,000 because we gave that away. And now we're going to do the arithmetic. 8 plus 4 minus 2 is 10. So our ending retained earnings is $10,000. And our total stockholders' equity, our total ownership, the total value of the company to our shareholders is $46,000. Again, please, none of this is difficult. It's just learning the language. Once you learn the language, you'll have it. It's not all that tough. Now let's go on to the next piece. They ask us to do a balance sheet. And a balance sheet is really just a list of all the things that we have minus all the things that we owe. And what's left is the shareholders' equity. So the assets, all of these things up here, are what we have. The liabilities are what we owe. And the stockholders' equity is what we own. So let's go through and fill in these pieces. And again, we're going to go back to that very first part of this part 1 that we did, and we're going to take a look. So we need to see what our cash is. So our cash is right here, $32,000. And our land is right here, $24,000. So our cash is $32,000 and our land is $24,000. So our total assets are $56,000. Now, that's an important number because at this point you should be savvy enough to realize that whatever we have here is got to be what we end up with here. Because if this is all we have, and this is a total of what we have and what we owe, that includes everything. So the top part of the balance sheet, the assets, will always equal, unless you made a screw up, the total in liabilities and equity. And I got to change my notes here so I'm not saying stupid things while I'm talking to you, or not saying accountingly stupid things. I could still say stupid things. I'm good at that. So I only have one liability, and that's right here, the note payable, $10,000. That's a liability. And again, the way to remember liability is to say it correctly. Liability, things you owe. We owe $10,000, so that's our note payable. That's our only liability. Now, in the real world, companies may have hundreds, if not thousands, of liabilities, but that's, in this limited accounting world, that's what we have. Now, you know, when it's all said and done, this plus the total stockholders' equity has to equal $56,000. You know that stockholders' equity then has to be the 56 minus the 10, so the total equity is 46. So let's see if that's what our numbers add up to. It's a nifty little way for you to check yourself. Well, our common stock is 36. So common stock, 36,000. And our retained earnings is 10. Well, 36 and 10 looks like 46 to me. It balances. Good job. The only thing left for us to do, and this is the one that you kind of have to think about a little bit. And we have to look at the cash, and we have to look at how much cash came in and how much cash went out. We're going to do a statement of cash flows. And the statement of cash flows, we're going to break things down into 3 categories. Cash from operations. How much cash did we get doing what we do? That's cash from operations. Cash from investing is how much cash we bought or spent buying property, plant, equipment, things like that. And cash from financing is how much cash did we get by selling stock, taking notes, things like that. So, again, let's go back to that very first sheet we had. And take a look. cash from operating will be cash from customers, cash for utilities, cash for rent, cash for salaries, cash for executive cars, cash for all kinds of stuff. Well, in this case, our only cash in is from customers right here. Provide services, $20,000. So cash payments from customers is $20,000. We have cash for utilities expense. That's an operating expense. That was $1,000. So we have minus $1,000. And we have cash payments for other operating expenses, $15,000. So altogether, our cash from operations was $4,000. Now you may say to yourself, who cares? It matters because cash coming in from operations is the gold standard. It's what you want to see from a company. Cash coming in from investing activities is a bad sign, because if cash is coming in, it means they're selling their property, they're selling their plants, they're selling their machinery. That's not a good thing. That's a going out of business sale. So you want to see positive cash from operations, but you're not happy about positive cash from investing. So they bought some land for $12,000. So that's the direction we like to see. So we have cash going out, $12,000. So cash from investing activities, $12,000 out. That's what we want to see. Now, cash from financing activities, this is when we buy, or not when we buy, I'm sorry, when we sell stock, when we sell bonds, when we take loans, when we take mortgages. These are all the things that go to the capital structure of our business. And in this case, and again, all of these numbers are coming back from this original set of transactions. Cash from the stock issue was $30,000. That's good. That means people liked our company enough to spend 30 grand to buy into it. Cash receipts from loan, that's $10,000. Neither good nor bad, just means that we have good credit. Somebody was willing to lend us $10,000. And cash payments for dividends, we gave some money back to our shareholders, $2,000. And that's kind of a good thing. It makes our shareholders happy. So we have 30 plus 10 is 40 minus 2. So cash from financing activities is a total of $38,000. Now we have to take a look at our total cash. Our net increase in cash is 4 plus 38, 42, minus 12, 30. So our increase in cash was $30,000. Going back to our original transaction list, our beginning cash was $2,000. Our ending cash should be $32,000. And we check our original equation, and sure enough, $32,000. So we did everything right. It all ties together. All the numbers work well. The last question it asks, it says, how much, what's the percentage of our assets were provided by retained earnings? What they're really asking is how much of our total assets were produced by our retained earnings. how much of our total assets we earned this year. So if you take a look, our total assets, and again go back to this, our total assets is $56,000 right here. $10,000 of that 56 was paid for by retained earnings. So if we take the 10,000 divide it by 56,000, we come up with 17.9%, and roughly 18% of the things we have were provided for us by money we earned. That's the concept.